For 40 years, the silver market ran on confidence and contracts. If you wanted silver, you didn't need a bar. You needed a login, a line in a database, a promise that somewhere, somehow, a bank or a vault had you covered. That era is ending because in the last few years, three things happened at the same time. Industrial demand hit records, especially from solar, electronics, and EVs. E-market ran 4 straight years of physical deficits, draining above-ground stocks, and new rules made it more expensive and less attractive for banks to sit on big, opaque metal positions. The result? More and more corners of the system are quietly saying, no more paper games. If you don't have the metal, you don't sell the metal. This is the physical-only future of silver. And once you see how we got here, you'll understand why, after banks failed to keep the illusion going, there's really no way back. A shortage you could touch. Let's not start in a boardroom. Let's start in a jewelry lane in India a few months ago. Local newspapers described something unusual. Silver shops turning customers away. Delivery delays stretching to a week. Spot deliveries charging big premiums over futures. And traders whispering that stocks are finished. India is the world's largest silver consumer. It imports more than 80% of what it uses. In 2024, Indian silver imports went wild. More than 4,000 tons in 4 months, more than the entire previous year's total, driven by solar manufacturing and investment. By 2025, things flipped. The government moved to restrict silver imports until March 2026 to tame the surge. Meanwhile, a global deficit and logistics issues meant imported silver wasn't arriving fast enough. Local futures traded one price. Physical bars in the bazaar traded it up to 10% above global prices. That's not a meme. That's a physical-only moment in miniature. Same metal, different realities. Screen price. Cheap, abundant, theoretical. Street price. Expensive, scarce, painfully real. India's shortage is a preview of the world the silver market is drifting into. A world where location matters, bar availability matters, and contracts alone don't always get you metal. How banks built a silver illusion. To understand why physical only is the future, you first have to understand the trick we've been living with. For decades, the core silver system in places like London and New York ran on what you could call fractional metal banking. It looked like this. Big bullion banks sit in the middle of miners, refiners, industrial users, ETF sponsors, and investors. They run unallocated accounts where silver is a promise, not a specific bar. They use futures, swaps, and forwards to hedge and trade. And they assume that not everyone will ask for bars at the same time. On paper, the market looked huge. In reality, a relatively small pile of bars could support many times that amount in claims and exposures, as long as trust held. It's like a high-end restaurant taking 100 reservations for a room with 50 seats, counting on no-shows and staggered arrivals, as long as the doors don't all open at once. And nobody demands proof of the kitchen's inventory. Everything looks fine. The bank's role was simple. Keep the music playing, manage the float, profit from spread and leverage. For a long time, that's exactly what they did. Then the rules changed. Then 2008 happened. The global financial crisis exposed something everyone had quietly known. Banks were running too thin, too fragile, too leveraged. Regulators responded with Basel III, a thick set of rules designed to force banks to hold more capital, fund long-term assets with more stable money, and stop treating everything as if it could be liquidated instantly without pain. Two parts of Basel III matter a lot for metals. The net stable funding ratio, NSFR, requires banks to fund long-term, potentially illiquid assets with stable funding. Precious metals exposures, especially unallocated, unbacked positions, now require a lot more long-term funding and capital. Risk weights and treatment of physical versus paper, fully allocated bullion sitting in vaults can get much more favorable treatment. Synthetic exposure, derivatives and unallocated claims are more expensive to keep on the books. Translated into plain English, if you want to keep big, opaque positions in precious metals, you now have to tie up more capital. The easy, cheap paper metal game is over. Some banks adjusted, some pulled back from certain activities. Some quietly shrank their role as market makers in metals. The important part is this: the entities that used to be able to flood the market with contracts at will no longer have the same freedom to do so. The paper supply shock absorber got smaller. At exactly the same time, something else was happening to the physical side. The silver deficit era. Now imagine shrinking the paper buffer while the real-world demand keeps grinding higher. According to the Silver Institute and multiple industry analyses, global silver demand hit record or near record levels around 1.2 plus billion ounces per year in 2023, 2024. Industrial demand alone from electronics, solar, EVs, and power infrastructure has set records, crossing 680, 690 million ounces in 2024. Mine supply, on the other hand, has been struggling and mostly flat for a decade, with the Silver Institute projecting a further small decline in 2024. Net result, a string of annual deficits. Demand exceeding total supply by anywhere from 140 to 200 plus million ounces in recent years. Where does the extra metal come from in a deficit? Not magic. It comes from inventories, exchange vaults, private holdings, government stocks, industry buffers. According to one analysis, above-ground silver stocks have fallen from about 22 months of supply in 2020 down to roughly 12 months by 2024, as repeated deficits chew through the buffer. On top of that, visible stocks at COMEX and LBMA have dropped sharply. COMEX silver inventories fell from over 400 million ounces in early 2021 to around 290 million ounces by mid-2024. LBMA reported its own sizable drawdowns, so we have less willingness from banks to create infinite synthetic silver, increasing industrial need, multiple years of deficits, shrinking above-ground stocks. The illusion was that paper could always smooth out reality. The reality is now catching up. The Eastern pull and the rise of fully funded metal. There's one more layer to this story. The power over gold and silver price discovery used to be overwhelmingly Western, bank-dominated, derivatives-heavy. Now, that's slowly shifting. In gold, we've already seen China and other Eastern players build out physically settled exchanges where contracts must be fully funded in cash and are more tightly linked to real metal flows. Sprott, silver tends to follow the same pipelines. Miners sell concentrates. Refiners turn them into bars. Bars flow to where they're best paid for and where counterparty risk is lowest. Every time a Western contract goes into backwardation, near-term prices above longer-term, lease rates spike, premiums open between paper and physical. That's a signal. Move bars here, not there. They're needed more and paid better in physical first markets. We see this in data points like India's wild import surges in 2024 as it ramps solar cell production and investment demand. Repeated reports of local shortages, festival premiums, and ETF subscription suspensions due to high acquisition costs. Bit by bit, metal moves out of transparent Western vaults into long-term, do-not-come-back hands in industry and Eastern savings. And once it's there, it doesn't easily return to being a raw material for leverage. That's the deeper meaning of physical only. Bars leaving the casino and entering the real world. What banks failed actually means. So when we say after banks failed in this title, we're not just talking about bankruptcies. We're talking about 3 specific failures. They failed to keep precious metals off balance sheet and invisible. Basel III's NSFR and related rules dragged more of that activity back into capital-intensive daylight. They failed to maintain the illusion of infinite, costless paper hedging. As volatility in silver spiked, with 30-day realized volatility hitting around 40% in late 2024, well above the long-term 20-25% norm, those positions got more painful to run. They failed to stop physical from leaking out under higher bids elsewhere. When multiple years of deficits and record industrial demand collide with regulatory pressure, the quiet arbitrage is simple. Sell the bar where it's treated as Tier 1 fully funded collateral or into industry, not into a low-margin, high-capital, heavily regulated Western derivatives loop. Banks didn't fail in the sense of no longer exist. They failed in the sense of we can no longer be the cheap, invisible backbone of a massively leveraged paper-silver system. And once that capacity shrinks, the market has no choice but to re-anchor itself in physical constraints. That is the physical-only future, the 3 rules of the physical-only silver era. So, what does this new era actually feel like? Let's lay down 3 rules of the physical-only silver world. Rule 1, if you can't deliver, you can't dictate. In the old system, a large institution could influence price with contracts, not bars. Today, that's getting harder. Exchanges, regulators, and counterparties are more cautious about naked shorting, more demanding about margin, more sensitive to the gap between open interest and deliverable supply. Meanwhile, industrial users in Eastern hubs care less and less about your swaps. They care. Can you ship 40 tons of 99.99% silver to this port by this date? Do you have the bar list? Who is the custodian? If you can't answer that, your ability to steer price is limited, no matter how clever your risk models are. Rule 2. Above ground stocks are the new central bank. Official central bank gold reserves anchor the gold market. Silver doesn't have that luxury. Instead, its central bank is exchange inventories, private vaulted holdings, industrial and commercial stocks. When above ground stocks were at the equivalent of almost 2 years of demand, nobody cared much. Now that they've been cut roughly in half, every extra deficit year makes the system more fragile, more sensitive to shocks, more likely to experience spot shortages in certain regions or product forms. In a physical-only world, the size and location of those stocks matter more than clever ETFs. Rule 3. Industrial users set the floor. Monetary fear sets the ceiling. More than half of silver demand now comes from industry. Electronics, solar panels, EVs, chemistry, medical equipment. That means, at some price, engineers fight to substitute or thrift silver. Below that price, they gorge on it because performance matters more. That sets a moving floor. On the other hand, when currencies wobble, when inflation scares people, when trust in banks and bonds erodes, investors reach for monetary metals. Gold first, silver second. That sets the ceiling pressure. In a physical-only future, the floor rises if deficits and industrial demand stay structurally strong. The ceiling gets tested when financial panic meets tight physical supply. The zone between those two is where the future silver price will dance. How this changes the game for normal people. Okay, that's the big picture. What does this actually mean for someone sitting at home watching this on a laptop? Let's break it into 3 lenses. How you think about silver, how you access silver, how you size silver in your life, how you think about silver in a physical-only future. Silver is not just a speculative chart, a poor man's lottery ticket, a pure inflation hedge. It's also a critical industrial metal at the center of solar, electronics, and high-tech, a monetary pressure valve when people lose trust in paper claims. Oh, your mental model shouldn't be, will silver moon, but rather, in a world of repeated deficits and tighter physical settlement, what role does this metal play in my overall resilience? How you access silver. Not all silver exposure is created equal. In a world drifting toward physical discipline, fully allocated vaulted metal with clear bar lists and audits is higher on the trust ladder. Unallocated accounts and leverage-heavy products sit lower. Then there's physical in hand, pros. Zero counterparty risk, directly plugged into any future physical premiums, storage, security, taxes, depending on jurisdiction. Then there are ETFs and ETCs that claim to be fully backed, easier to trade, but require trust in structure. Miners and royalty companies, leveraged but vulnerable to cost overruns, politics, and mismanagement. In a physical-only future, the closer you are to real bars, the less you are relying on the same banking system that already pulled back. That doesn't mean everyone needs to bury kilo bars in the garden. It just means you should know exactly where in the chain your exposure sits, how you size silver in your life. This is not financial advice, but here's a rational approach for a normal person. Assume silver is volatile. Assume you might be early, wrong, or blindsided. Size positions so that they matter if you're right over a decade. They don't destroy you if you're wrong over a cycle. In a physical-only world, you will see brutal drawdowns, sudden spikes, local shortages, premiums in one market while another is in correction. So your job isn't to perfectly time every move. Your job is to decide how much of your net worth you're willing to allocate to a metal whose entire game board is shifting from promises to proof